Good evening, everyone. CFA Society is pleased to present the Let's Talk Digital Asset webinar. This event is keeping with our strategic objective of providing member and candidate value and providing support in becoming the most trusted and respected in our respected fields. We aim for 100% member satisfaction. We're particularly excited to have been able to extend the invitation to CFA Society Cayman, CFA Society Trinidad, and CFA Society Bahamas. So welcome everyone to this webinar, and we look forward to your contribution. We're excited to have with us today our presenter, Matt Hougan, and Matt would have joined us last year and would have shared with us a deep dive into cryptocurrency. He is here today to expand on that and will share with us further development in digital assets, NFTs. For those of you who weren't able to join us last year, Matt is one of the world's leading experts on crypto ETFs and financial technology. His thoughts on investing has been widely profiled in the media, including Bloomberg, New York Times, Wall Street Journal, CNBC, and the Financial Times. He is currently the Chief Investment Officer for Bitwise Asset Management, and Bitwise is the creator of the world's first cryptocurrency. Matt, welcome again, and I am going to hand over to you at this point.
Oh, thanks so much. Thanks everyone for having me today. It's wonderful to be invited back. I also aim for 100% satisfaction. So it looks like I did well enough the first time that you were happy to have me back. I think what I want to do today is spend about 20 minutes talking about crypto blockchain and specifically about NFTs. You've probably heard a lot about NFTs. You've probably laughed at NFTs. You may have seen that someone paid $3 million for a digital rock, and you may have wondered, why did they pay $3 million for a picture of a digital rock? I'm going to try to explain that to you and also explain why, despite the absurdity of that example, NFTs are a really important new technological capability that I think are going to significantly impact the world. So I'm going to try to share a few slides. Let's see if I can do that first. This is always the most challenging part of the presentation. Great. Can you all see this? Thumbs up on the slides. Great. All right. Crypto, NFTs, and the future of everything in 20 minutes. This is going to be a fun talk. Here's what I'm going to talk about briefly. 1 minute on who is Bitwise, so you should know whether you should listen to me or not. A very quick refresher of what I talked about last year, sort of what is a blockchain at its fundamental level, because I think understanding that is the key to understanding what NFTs are. And then we're going to talk about what are NFTs and why do they matter. But let's kick off. As Carrie Ann mentioned, Bitwise, a crypto asset manager. We've been around since 2017. We manage over actually $1.5 billion in assets right now. We're best known for having created the world's first crypto index fund. We also created the first NFT index fund, which went live earlier this year. So we're active in this market as well. I've been fortunate to do a number of things, including co-author the CFA Institute's guide to Bitcoin, blockchain, and cryptocurrencies, which you can download from the CFA Institute Research Foundation's website. It's a 64-page intro to what crypto is and what it isn't, and hopefully you can find that valuable. All right, this isn't a commercial for Bitwise, just to give you some context. I want to spend 5 minutes reminding everyone my view of what blockchain really is and how it works, because I think that'll help inform what NFTs are and how they fit in the ecosystem. If you remember last year, I started with this slide. It's still one of my favorite slides. Many people think of crypto and blockchain as a new alternative currency. They think about it the way we think about dollars and pounds and euro and yen. One important thing is I think that framing is wrong. I'm the CIO of one of the world's largest crypto asset managers. I live in the San Francisco Bay Area in the States, one of the most tech-forward places in the world. I've never bought a coffee with Bitcoin. That's not what Bitcoin, not what blockchain is about. What crypto and blockchain is about taking money and moving it into the internet era. And I show this in two ways. This slide Shows you how money moves in the current financial ecosystem on the left. It's all intermediated. I send a check to my friend, they deposit it at their bank checks with my bank to make sure my account is good. And after they come to agreement that my account is okay, my friend can withdraw the money from his bank. One way to conceptualize what crypto and blockchain does is it lets me send money the same way we might send a WhatsApp or a text message. It lets me send money or items of value directly from one person to another. The way I like to explain how this works is to use the example of PayPal. And I promise this is critical to understanding what NFTs are. So I am getting there. The reason the traditional financial ecosystem is slow, the reason if I wanted to wire money to you in Jamaica, it would take 2 business days, is that the traditional financial ecosystem is a series of thousands of databases. So my bank here in the States and your bank in Jamaica aren't running the same database. So if I want to wire money to you, my bank has to talk to your bank, has to make sure that I actually have the money, that I haven't sent it to multiple people. And only after they come into agreement can money or an item of property move over digital rails. Now, we have financial apps that have solved this. Here in the US, we use PayPal quite frequently. I can use PayPal to send money to a friend and they get it instantaneously. The reason PayPal is so quick and traditional banks are so slow is PayPal is one database. So if I want to send money to my friend in PayPal, PayPal can look, it can see that I have that money, it controls every transaction. So it knows I haven't tried to send the same money to 20 people, and it can move it to my friend's account instantaneously. In other words, one database is fast, multiple databases are slow. The reason this is relevant to us today is because all a blockchain is, when you hear the word blockchain, what I want you to think of is it's one database that's available everywhere in the world that everyone can see. Everyone can look and see the state of it. Everyone can interact with it, but which no single third party controls. So it's one database available everywhere that everyone can see, but no single third party controls. I can look at the Bitcoin blockchain and see how much Bitcoin is in every address. You can look at the same database and see how much Bitcoin is at every address. Everyone in the world can look at this database and verify what's true. This was a big computer science challenge. The Bitcoin blockchain was the first blockchain to solve this challenge, and all subsequent crypto assets and blockchains are built on this same idea. One database available everywhere that everyone can see. Now, the reason that's important, and I promise we're getting to the NFT part, is it allows us to do 3 things we've never done before. One, I mentioned earlier, we can move financial goods over the internet at internet speeds. Again, if I wanted to wire money to you through a traditional bank, it would take 2 days, even though I may be working with the largest banks in the world. But if I wanted to move $1 billion over the Bitcoin blockchain, I could send $1 billion to literally anyone in the world and have it settle in 10 minutes. And the fee would be only a few dollars. A single database is faster than 1,000 fractured databases, and blockchains allow there to be one database that everyone can interact with. The second thing crypto allows you to do, blockchains allow you to do, is to program money like software. So today, a lot of what we do in finance is we wrap simple if-then statements in a suit, and we charge a high fee. You know, a trust agreement, give X dollars to my son when he turns 30. All that is 2 if-then statements. And right now we use lawyers and financial institutions to set up trust agreements to process that. But in this new blockchain-enabled era, we can program that in software. And there are lots of examples called in the decentralized finance world of people using this capability to do things that used to take multiple days and have high fees, to process them instantly at very low costs. As an example, you can use a crypto-enabled blockchain to get a $100 million collateralized loan in a matter of minutes at extremely low costs. So this is the second thing crypto allows you to do. But the third, and the reason we're here to talk about NFTs, is that crypto creates digital property rights for the first time in history. And if you can get this, you can get why NFTs are important and why they're going to be, I think, one of the most fundamental technological breakthroughs of the last 10 years. Before blockchains, the only way you could own a digital good was if someone kept a record that said you own it. Take my bank account. I have a bank account at Wells Fargo Bank. It's 10 numbers. The only reason those 10 numbers belong to me is because Wells Fargo maintains a database that says Matt owns these 10 numbers. Otherwise, you could take my checkbook, write down the numbers, and create an infinite number of copies of them, right? Just by pushing Control-C, Control-V on your keyboard. Prior to blockchains, the only way you could own a digital good was by having a single third party maintain a record that says you own it. But once we have a database that's available everywhere, that everyone can see, that everyone agrees is true, that updates in real time, all of a sudden you can own something and prove to anyone in the world that you own it without any third party blessing it. If I own a Bitcoin, as an example, I can go anywhere in the world and prove to anyone that I own that Bitcoin because I have the special password that unlocks it and lets me send it anywhere. Blockchains, crypto, allows you to own digital items in the same way that I own this glass, or you might own a Picasso on your wall, or I own this pen. You can own them in a fundamental sense. And this is actually, I would argue, the biggest single breakthrough that blockchains enable, the idea of digital property rights. So how does that tie into NFTs? Well, if you think about Bitcoin, the Bitcoin blockchain enabled individuals to own Bitcoin. But the thing about Bitcoin is that every Bitcoin is like every other Bitcoin. Every Bitcoin is fungible. If I own a Bitcoin and you own a Bitcoin, they're worth exactly the same amount. We could trade them and we wouldn't exchange any value. Bitcoin is fungible because one Bitcoin is like another. You can divide it into 1,000 different parts. It's a fungible asset. The idea behind NFTs is, what if you took this ability to have digital property rights, the ability to go anywhere and prove that you own a particular good to anyone without a third party blessing it? What if you took that capability but made it specific? So instead of owning 1 out of 21 million Bitcoin, you owned 1 out of 1 specific digital good. And I have an image on here from something you probably read about in the news, which happened last year when Christie's held an auction and someone purchased a piece of digital artwork for $69 million. It's called a Beeple. It was the largest digital artwork sale in history. And what did they purchase there? They purchased an NFT, which is to say a unique certificate of ownership transcribed on a public blockchain that proves that this person is the owner of this particular work of art. Now, I'm not here to try to convince you that it was worth $69 million to own this particular digital file, which, to be clear, someone else could copy and paste and hold on there and look on their computer. They wouldn't own the original, but they can copy and paste it. But it is interesting to note that this was the first major digital art auction ever. People have been doing digital art for decades, but only after the advent of NFTs did we start auctioning digital art and having real value, because for the first time we could own a digital good in the same way that we would own a physical good. Now, currently, what you're seeing is many early applications of this, some of which I've put on here. You're seeing gaming platforms allowing people to own items in games and move them around in different worlds. I've shown here 2 CryptoKitties and Axie Infinity. These are blockchain specific games that are based on this idea of ownership. Other applications are more ethereal. You have platforms and large companies like JP Morgan buying digital real estate in metaverse-like worlds. We've seen huge applications in the artwork space. I just showed you the $69 million Beeple artwork that people auctioned. And we're seeing increased applications in area like ticketing. People are talking about making Super Bowl tickets into NFTs and such. The largest market for NFTs right now are what's called digital collectibles. And I've put up examples here. These are artworks that are issued in collections. So for instance, CryptoPunks on the far left was one of the first examples of NFTs. These were 10,000 unique characters. You can see this pixelated image of a woman here. and 10,000 people have bought these and they've appreciated significantly. Some of these NFT community collectibles are more traditional art like. The autoglyphs and fidenzas look like traditional modern art, and some of them are more cartoonish. They're different than artworks in two important ways. One, they are communities. So when you buy, say, a Bored Ape, you're invited to a Discord channel where you can connect with other people who use Bored Apes. And two, they're inherently digital. But in the end, these are a major market. Now, it's worth noting these are become extremely valuable assets. There are 10,000 CryptoPunks out there. The cheapest one available for sale today is $180,000. This may strike you as absurd. There's certainly an argument to be made that it's absurd, but these are among the first digitally native pieces of art in the world, and people have ascribed significant value to them. Here, if you want a gauge of it, is the relative price context for CryptoPunk NFTs from their inception until today. You can see for a long time, they were worth essentially zero. I wish I had bought all of them in 2018 and 2019. And today they trade for hundreds of thousands of dollars. The things that are unique about NFTs, which are worth keeping in mind, is that they are digitally native pieces of art. They are surrounded by communities. They are liquid, unlike traditional artworks, and they can be embedded with functionality. And that last piece is really interesting. If you take something like the Bored Ape community, you have the ability to use those Bored Apes as tokens to get access to special events. You have the ability for fashion houses to drop merchandise to that group. So they're kind of like artwork and kind of like pieces of culture. Let's see. It's worth noting, I know all of this sounds very avant-garde, very strange, but mainstream brands are aggressively entering this market. This is an example of Adidas, which is moving aggressively into the NFT space in multiple ways, including creating its own digital art collections, as well as selling digital representations of its fashion items that people can use in metaverse settings. You also have firms like Burberry's moving into this space as well, creating specific characters and dropping them into games. Again, these are all sort of almost playthings. Yeah. But one of the things that's true about them is they're reflective of this ability to own digital property rights. I just add one more thing, and then maybe we can move into Q&A. While many of the earliest applications of NFTs have been in this zone of artistic goods, and you can argue whether they're artistic or not, we are seeing many more real-world tangible applications of NFTs. And this is one of the things I'm most excited about. I've highlighted two here. The one on the left is a space that's expanding very rapidly right now, which are music rights. Today, if you're a fan of a musician who hasn't made it big yet, you can tell your friends about it. You can go to concerts, you can get merchandise and wear that around to gather street cred. But one thing that artists are starting to do is to sell the digital streaming rights for new songs as NFTs. So here's an example of Nas, Grammy award-winning artist, incredible rap artist, who has actually sold the digital streaming rights to two of his songs as NFTs. You can see here that when this launched, you could have bought between 0.01 and 1.5% of the digital streaming rights to one of his specific songs. These NFTs also enable you to get special access to merchandise or to attend conferences, concerts, etc. This is an example of how this core idea of digital property rights can be applied beyond the artistic setting. Right now, instead of just telling your friends about this new band, you'll be able to actually invest in their music and own a share of the revenues if they become more and more popular over time. I expect that this sort of NFT music rights application is going to significantly remake how the music industry works over the next 10 years, and it's growing at an exponential rate. On the right, just to give you another example of the application of this technology, people are now thinking about how we can use NFTs to give individuals ownership over their personal health records. If you go and visit one doctor and he takes notes onto your personal medical records, and you go and visit another doctor and another doctor, it's not always clear that the notes from one doctor make it in perfect format to each of the other doctors. One application of NFTs would allow you as an individual to be owner of your own medical records, and doctors would be invited to write new information to your medical records. But when you went to a new doctor, you could carry that along with you, and you would have your private key that would allow you to unlock those medical records for your doctors to use. Again, you sort of in closing about NFTs, there's a lot of hype, a lot of bubble activity, a lot of extreme prices, and a lot of skepticism around NFTs, because you're seeing digital artworks, some of which is good, some of which is less good, selling for really significant prices. And I think many of those digital artworks will eventually lose a lot of their value, and some of them will become particularly valuable in the future. But more broadly, what we're seeing is this idea of NFTs as an expression of digital property rights becoming a major new technological primitive that has applications in many things, from music to medical records to gaming and so on. I think you're going to hear a lot more about NFTs in the next 3 years than you did in the past 3. I'm going to close with one comment, and then we'll move right into Q&A. This is the chart I've been using to describe where we are in the crypto market. And if many of you are fans of sort of the history of technology, you may have seen this chart. It's from a 1991 book by Jeffrey Moore called Crossing the Chasm. And it talks about how new technologies often find an early adopter market, and then some of them enter the mainstream market. You probably have a friend who just loves new technologies, who's always on the cutting edge. People are willing to try new things just because they're cool and interesting and different. If you think about the internet in the early days, the early adopters were like the military and kids on college campuses. And then we got things like Google and Facebook and Hotmail, and it entered the mainstream market. Often technologies don't make this leap. Virtual reality is an example of a technology that's long had an early adopter market gap, but it's fallen into the chasm. It's never gone mainstream, because when many of us put on those VR goggles, we feel disconnected from the world, or we actually feel nauseous or ill. The thing that separates the early market from the mainstream market is wide mainstream use, wide mainstream applications, and ease of use. Once the internet became integral to our daily lives, and once it became easier to use, it went to the mainstream. What we're seeing in crypto today, partially in payments, partially in things like Web3, partially in things like DeFi, and definitely in things like NFTs, is it beginning to penetrate this mainstream market. The embrace of NFTs by everyone from Adidas to Burberry's to Nike, as well as to musical artists, as well as to some of the traditional pictorial artists in the world, is an example of crypto going into this mainstream market. And I think as you watch the space evolve over time, think about this maturation process from an early market where it could do cool things, but you weren't sure what the real world applications are, to something like NFTs disrupted musical digital streaming rights. And that's really where I wanted to drop off. I'll close my sides and we can do some Q&A. If I had to leave you with sort of last thoughts, you're going to see a lot of news articles about NFTs. You're going to see a lot of articles about goofy looking digital art selling for a lot of money. You may want to avoid investing in that art, or you may not. I'm not here to tell you that. But what I am here to say is that this core technology of NFTs has significant applications beyond just that artwork. And you'll be paid back by investing in your education to think about what those applications might be. And that's my presentation today. Let me stop sharing and we'll go into a few questions.
Thank you so much, Matt. As usual, you've exceeded my expectations. I know that the audience is eager to engage with you. We've had a lot of interest coming up to this. I forgot to mention that if there's any question that they could place it in the chat. So I think that's my fault. That's why we're not seeing any questions in the chat just yet. So I'm going to give everybody like a minute to drop your questions in the chat. Remember, Matt is a leading expert in crypto and digital technology in the world. So guys, feel free to ask any question that you might have. In the meantime, while you drop your question in the chat, we're going to launch our first poll question. And this question is just going to ask you, you know, how did you hear about this webinar, so that we have some idea about where our audience is coming from. So you guys can just quickly answer those poll questions. I'm seeing 2 here. All right, Dania, you can let me know when we have a good enough response rate. And then we can go directly into the Q&A. Also, guys, if you want to raise your hands, feel free. You can open your mic and ask the question. Dania, can you go ahead?
Yes, Karen, you can go ahead now.
All right, so we have a question here from Monique French. How do you verify that the transaction or purchase is a valid third-party transaction? And she noted that she has seen cases or claims of persons buying their own NFTs to make it appear that there is demand for sale.
Yeah, Monique, such a great question, and so very true, and an important thing to call out. The NFT market is a nascent developing market, and the regulatory safeguards in this market are really very limited, and that's important to note. And as a result, you do see a lot of wash trading, particularly for new NFTs. There is no simple way to determine which NFTs are engaging in traditional true price discovery versus which NFTs are subject to this kind of wash trading. Our view at Bitwise is that the larger, more established NFTs are more insulated from this activity than newer NFTs. And so I would be skeptical of NFTs that have been on the market for a limited period of time and have shown, you know, sort of a direct run up in prices. You want to see something that looks like native price discovery. I think the NFTs that have been on the market longer, something like the CryptoPunk NFTs or the Bored Ape NFTs or those top tier NFTs are probably more insulated from that. The other rule of thumb, I would say, many NFTs should be thought of as artworks, and you should be buying them because you love them and not in the expectation of profit. But it's a great question. You do have to be careful out there. It's not a fully regulated market.
Thanks for that, Matt. A follow-up question from Monique. What is the expected impact of NFTs on middlemen in the creative space over time?
Yeah, it's going to remove middlemen, and that's going to be great. It does so many good things. Middlemen take out so much of the value in artistic transactions, whether that's in visual art or musical arts or other arts. And NFTs allow creators to connect directly with their fans with very little intermediation, fees that are measured in single percentage points instead of 20, 30, 40 percentage points. I'll also add one neat thing that may not be obvious to people. If you're a young artist and you sell a painting and it sells for $1,000, and then it turns out you're incredible and your art eventually becomes worth millions of dollars, you don't actually benefit from that, from those early initial sales. One unique thing about NFTs is you can embed royalties back to the artist for all future sales, such that if an NFT is sold today, and then it is sold tomorrow, and then it's sold tomorrow, the existing artist will benefit from that. And if you think about, in particular, some famous artists who unfortunately passed away early. So a good example is Basquiat in the US. he didn't benefit much from the value of the artwork he created, nor did his family or related foundations. But if you attached a royalty to all future sales, he would have. And so I think it's I think the middleman will get squeezed out. I think the world will be a better place, and I think artists will have better one-on-one connections with fans.
Wow, Matt, thanks so much for that response, because I did, in all my research and preparing for this webinar, I did not realize that royalties was included as part of NFTs. All right, so we're getting a lot of questions here, Matt. All right, question from Bob Russell. Has the recent monetary stimulus by the Fed contributed to the rise in the value of NFTs? Or is it just that values are being inflated as there are more and more adopters? Oh,
Bob, both things are true, I think, is the answer to that. My general view of the world, and I'm not a Fed monetary expert, right? I'm a crypto expert. My general view of the world is the world's been awash in cash. We've had aggressive monetary stimulus from the Fed and from other central banks around the world. And I think that's inflated the price of all risk assets. You only have to look at the relative PE ratios of high growth stocks versus their historical norms to know that we've gone through a period of asset inflation. And I think NFTs, particularly being on the tail of the risk spectrum, have benefited from that. At the same time, and the reason this is a complex market, I think there are also these underlying secular trends behind NFTs that are making them more valuable over time. There are more adopters. The role of the digital world is getting more important. Facebook rebranded as Meta, right? We're aggressively moving into this more digitally native transaction. And as a result, a technology that enables digital property rights and some of the early examples of what that technology can do, it's not surprising that those have become more valuable. The part of the question I don't have an answer for, Bob, is what amount of that value is represented by each. And if the Fed withdraws stimulus, could the rise in NFTs compensate for that? And I don't know. I think this is going to be a volatile market. I'm bullish over the next 3 to 5 years. And inside 3 years, I think we could have significant volatility in NFT prices. You could see a 70% drawdown or a 70% run up. I think both are equally possible.
Thanks for that, Matt. So I have a comment here from Jodian Hall, and I'm very interested to hear your response. So she says, so basically NFTs are the non-fungible version of Bitcoins. And secondly, if so, will this be the next version of Bitcoin, or is it just a bubble?
Great question. The first part, yes, NFTs are the non-fungible versions of Bitcoin. That's a very good way of framing it. Bitcoins are fungible tokens and NFTs are non-fungible tokens. So Jodianne, you have it exactly right. I don't think they will disrupt Bitcoin. I think of Bitcoin's role in the world as sort of like digital gold. It's this digital non-sovereign currency. And if you want digital gold, you want it to be fungible such that one asset is exactly valued like another asset. That lets it be liquid, lets it be exchanged in different places. Once you make it non-fungible, you inherently make it a less liquid market and you get more into idiosyncratic characteristics. So I don't think they're a challenge to Bitcoin. I just think they're a new expression. If you want to know what I really think the price of these like Bored Apes and CryptoPunks is driven by, I think of them as a derivative of the wealth being generated in crypto. So you had this crypto emerge from zero to a $2 trillion asset class. And you have all these people who have made a lot of money. And these are people who are digitally native and they like digital things. And they may be young, probably younger than me. And they may have different artistic tastes and they may like things that are liquid. And so I think it's really a reflection of people get rich and they want to own cultural artifacts. I think that's true of every sort of rich generation. People got rich in the 50s and they bought Warhols. People get rich in the 20s and they buy CryptoPunks. And just like my great grandparents laughed at Warhols, my father probably is laughing at CryptoPunks.
That's a good way to put it, Matt. All right, so I have a question here from Damian Brown. It's two questions in one. So I'm going to take my time and I'm going to go ahead and read it. So Damien is asking, with respect to decentralized finance and lending based on cryptocurrencies, what are the modalities to validate the reliability of an exchange? Will this expand beyond margin lending based on the borrower's value of existing holdings of cryptocurrencies? If you want me to repeat any section of this, I will do that.
No, that's great. I got it up here too. So it's a complex question. I'll answer the first one. With regards to DeFi and lending on crypto, what are the modalities to validate the reliability of an exchange? I think there are probably two. One, it's not easy. Again, this is on the frontier of the regulated space, so we don't have the same safeguards that we do in traditional finance. But there are a couple of signal things you can look at. One is time on the market. And that sounds so obvious, but I think it's overlooked by many in crypto. If you think, Damien, some of the oldest decentralized finance applications, something like Compound, is not the slickest, it's not the highest yielding, but it is the one that institutions are turning to, right? When Coinbase wanted to use a DeFi protocol to generate yield for its customers, it turned to Compound. Why? Simply because it's been around for longer. And when a technology is around for longer, it's had more people poke at it, it has more people test it, it's been through more volatile periods. And so they've probably sniffed out if there are any major vulnerabilities. So that's one of the modalities I use. The other modality is really the VC backers. The more you have high name, high quality VCs like Parify or Electric Capital or Paradigm or Pantera or Andreessen backing a particular new DeFi application, exchange, or protocol, the more I would suspect that they've done due diligence from a technological perspective. Those two rules will cause you to miss some of the most exciting things. So the flip side of being conservative is you miss some exciting things. But those are some of the modalities. And then will we move beyond margin and collateralized lending? That's a really good one. I think so, but I don't yet know how. I think so, but I don't yet know how. The issue with under collateralized lending is that if you need to make a claim, you typically have to go through a traditional legal process. The reason collateralized loans work so well in the DeFi ecosystem is that you can prosecute those loans if you hit margin limits and claim the underlying asset without entering the traditional legal system. Once you have an under collateralized loan, you start to lose that capability. You start to intersect with the traditional legal system, and the traditional legal system doesn't move at the speed of the DeFi ecosystem. So you have a speed mismatch. There are a lot of people working on how to do that kind of under collateralized lending in the DeFi space, but I don't think anyone's yet cracked it. So it's a great question. I hope they do.
Damien, I really hope that Matt answered your question. If you have any follow-up questions, just drop it in the chat and we can do a follow-up discussion on that. All right, so this one is from Robin Romdeem and it's related to the response that you would have given at the latter part of your response, Matt. From a developer's perspective, how do I determine what metadata to use in representing on-chain versus off-chain? Do I bake the metadata directly into the smart contract representing the tokens, or do I host it separately?
Robin, you've exceeded my capabilities. So I don't know the answer to that question. I'm not as native on the developer side. So I'll apologize for and say I'm impressed that you've reached the limits of my knowledge rather than try to guess.
Thank you so much for that, Matt. I think we do have two other questions here. All right, so Robin is giving you a question that I suspect is within your universe of knowledge. So she is asking, how to choose profitable NFTs as an investor?
Yeah, that one's more in my framework. Also, I should say I've been doing a lot of webinars. I haven't been stumped in a while, so kudos to to Robin for her first question. How do you choose profitable NFTs as an investor? It's hard. I mean, Bitwise's approach is relatively simple, which is we don't know effectively how to do that necessarily. So we've created an index fund that lets you buy the most valuable NFTs with the idea that the most valuable NFTs will remain a derivative of broader crypto wealth as it grows. And so diversifying beats picking. If you wanted to pick, I think it's hard. I mean, the reality is most NFTs are not profitable. Many of them mint and then go down in value. Outside of the blue chips, I really emphasize buying something that you love, buying something that you're comfortable and happy about participating in the community with. And then if it loses value, you're not that upset. It's very hard outside of those top tier assets and with long holding periods. And even there's significant risk.
So Matt, I am tempted to ask, similar to how there are ETFs for cryptocurrencies, do you see an ETF for a group of NFTs?
You know, that's a really interesting question. I think it'll be some time before there's a traditional ETF. As I mentioned, we do have a fund. There also, I'll point you to a few, there's some decentralized autonomous organizations or DAOs that you can buy into and participate in, which are collections of NFTs. And that's another way to get exposure. You can almost, it's not an ETF, but it provides a similar diversification for exposure to some of the best NFT collections. I think that's a really interesting one. I'd point you to Google Flamingo DAO as one example of that, but there are a number that are out there. For now, I think we have a diversified fund. I know Osprey is another organization that's launching an NFT fund. And I suspect there will be more, but no NFT ETFs in the near term. Gary.
Thank you, Matt. Okay, so we still have a few questions here. Nastasia Rodok, what will protect investors from fraud in crypto environment? And she refers to the Squid Games crypto scam.
Yeah, absolutely. We're moving from a very unregulated crypto world to an increasingly regulated crypto world, right? So in the early days of crypto, there were huge amounts of fraud and scams and misrepresentations, and regulators are now aggressively getting their hands around it and squeezing that out. And it's getting significantly better. I would point to here in the US just yesterday, President Biden issued an executive order on crypto, telling every US regulator to figure out how to put operational safeguards around crypto, whether that's the SEC or the CFTC or the IRS or the OCC. We have a lot of regulators. In the interim, until we get to that fully regulated future, my guidance to people would be skeptical of things that are too good to be true. I see 4,000% yields on new DeFi protocols out there. A 4,000% yield is not a sustainable yield. And so if you see something like that you think this looks too good to be true, there's a good chance that it is. Now, there are unique opportunities in crypto. But yeah, be skeptical. And again, align with great partners. I do think that I made that point about VC backers. It's really not that hard to click through to see who the backers are of new initiatives. And if they come from traditional regulated environments or they have established reputations in the space, I think that can provide a lot of credibility. It's no guarantee, but it provides a lot of credibility.
Thanks for that, Matt. So I have a question here from Damian Brown that I am sure a lot of persons, they're interested in the response for this one. On the promise of the blockchain to allow companies to issue shares easily and provide access to wider markets, is this actually occurring in developing countries? And if so, which countries are good examples and what are the distinguishing features for those countries?
Yeah, there are two ways to, this is a great question. There are two ways to approach this. There's one example of allowing existing securities to have synthetic tokens that allow you to track them. And I point to like an exchange like FTX, which is headquartered, I believe, in the Bahamas. but provides access to these sort of synthetic exposures that lets you trade other equities 24/7, 365 from anywhere around the world and have them settle instantaneously. So that kind of service is actually not available to us in the US, but may be available depending on individual countries and their regulatory relationship with an entity like FTX. There's only the idea of securitizing smaller businesses and allowing you to access those through blockchain tokens really remains more of an idea than a reality, is the short answer to that. I'm not fully aware of what's going on in every country around the world from this perspective, but people have been talking about that for a long time, and it still, honestly, Damien, feels like we're a little way off. But I would point you to at least investigate what folks like FTX and others are doing in terms of providing synthetic asset exposure to traditional equities as a first step down that road.
Thank you so much, Matt. Just give me a chance. Let me check. All right. So I have the privilege of asking a question that is not in the chat. I'll ask another one. Of course, I have to bring in the ESG part of it, Matt.
Yeah, love it.
All right. Cryptocurrency and the blockchains. I want to know, are there ethical and I think it's more environmental issues for the expansion of the blockchain due to the high energy use that is required within the blockchain, especially given where we see oil prices going, given the Ukraine-Russia conflict?
Yes.
Yeah. I have to ask that. As a CFA member, I have to ask that question.
I love that question. And it's an acute question for me, something I care about deeply. The first thing I would say is you framed it broadly as ESG, Carrie-Anne, and I think it's important to note that there are a significant number of benefits that crypto may bring to the world that are positive on the S&G perspective. The level of financial inclusion in the world is pretty terrible. The fees that the traditional financial system charges to lower income people are extraordinarily high. The remittance costs for sending money from the US to abroad, for instance, are like 8%. Believe it or not, here in the US, it's actually gotten more expensive to wire money since 1880. The very first wire in the US was for $300 and the fee was $25. And today, if you wanted to wire $300 in the US, the fee would be $30. And that's 140 years later. Back then, we were like stagecoaches and cowboys. And it's just incredible that we haven't been able to serve more people with the financial industry better. So one of the reasons I love DeFi, one of the reasons I love crypto is it has the ability to lower the costs and widen the level of financial inclusion. So I think that's an important note. On the environmental side, Bitcoin consumes a fair amount of energy because Bitcoin's consensus mechanism, how it validates transaction and secures the network, consumes a lot of energy. There are other blockchains, like Ethereum is moving in this direction. Solana is already there, Avalanche, Algorand, et cetera. Most blockchains use a different consensus mechanism called proof of work that doesn't require any energy. It's almost carbon neutral. Instead of spending money on energy, you put up like money as bonds to verify transactions. The way I think of it is the way I think of the auto industry, which is I still drive a gas car and it pollutes the world. And my next car will be an electric car that's better for the world. And I think that's true for many people. Crypto is in the same transitionary point from a carbon intensive past to a carbon neutral future. It's important that those of us who care about it keep our hand on it to keep pushing the industry in this direction. But I actually think it's doing better than most industries. And I think it's making that transition pretty fast. And I think this story it's good we're focusing on it now. And I think it'll probably go away in the next 2 or 3 years as we get further down that transition.
Thank you so much for that, Matt. I think I have one question that I would not have raised. I wanted to leave it to the end. And I hope I'm pronouncing this name correctly. Suresh Martin. Person says, hi, Matt. Coincidentally, I was reading up on the 5 pulse on tokensets.com earlier today. And this person wants to know if that's what Bitwise offer.
Yeah, I love that.
This is a plug for you, Matt.
I love it. It's very similar. It's very similar. So you can buy an on-chain token exposure through token sets that's crypto native, that gives you exposure to a diverse panel of DeFi assets or a diverse panel of other assets. Bitwise does the same thing, but more in a traditional finance format. So we offer more traditional funds, onshore and offshore funds. So depending on whether you like your crypto exposure in a crypto native package, we really love what Token Sets is doing. I'd point you in the direction of Index Coop as well as another on-chain index fund provider. It's really, really interesting. Bitwise does that, but we're more of a traditional finance firm. So we offer traditional funds, but very similar products, I think, solving the same problems for different sets of investors.
Okay, and Matt, I must admit that a lot of what you just said sounds a bit foreign to me.
Yes.
So I don't know if there's an opportunity here for you to kind of break down exactly what you would have just communicated for the benefit of some of us who might not be familiar with the crypto.
Oh,
jargon.
sure. Yeah. So what Bitwise does is what most traditional fund managers do, right? We run mutual funds. So if you give us money, it's a traditional mutual fund. It looks like a mutual fund. And we take that money and we invest in NFTs. The same way a traditional fund manager might take in money from investors and buy a portfolio of stocks, we take in money and buy a portfolio of crypto assets or a portfolio of NFTs. So it looks and feels similar. What Token Sets and Index Coop does is, instead of sending money to a fund manager, you send money to a crypto address that uses technology, smart contracts, automatic routing to then directly buy a suite of tokens, right? So instead of you giving your money to a fund manager, what would be the equivalent? It would be like you sent money to a stock exchange and they invested directly in a handful of projects. It's just a different, or a handful of companies. It's a different way of getting exposure. Bitwise looks more like a traditional asset manager, and something like Token Sets or Index Coop looks more like a crypto native application.
I
tried my best.
I could see that one. There's the opportunity, guys. You have a strong foundation now. You can go out, you can research, you can YouTube, and of course, you can feel free if you want to connect with Matt. You can feel free to reach out to the society, and we're able to make that connection. So Matt, thank you so much. Thanks to everybody who participated in the Q&A section. I think before we wrap up, okay, Dean just messaged me to say that there is one more. Matt, are you up to taking one more question?
Absolutely.
Awesome. So this one, it says, so it's easier in terms of the technology risk to say, especially when starting NFTs, go through a fund manager.
Yeah, that is true. Buying an NFT is not as easy for everyone as buying a stock or buying something else. You need a particular kind of crypto wallet. You need to interface with new entities like OpenSea that you might not be familiar with. You have to choose your NFTs. So a lot of people who want exposure to NFTs, a fund is a better solution because the fund manager takes care of that and they have expertise. They know how to trade them. They know how to buy them. They know how to store them. They know how to use those wallets. So absolutely, in terms of what Monique is asking, yeah, fund managers make that simpler for people.
Again, that's a plug for Matt.
Yeah, I know. I try not to do it, but you know.
That's why I'm doing it, Matt. All right, so Matt, I know I said that was the final question, but I have one more. So thank you guys again for all the questions, but I think this is going to be our last question for today. Again, I say feel free if you need to connect with Matt. We're able to make that connection. So Matt, Suresh Martin is asking, Matt, if Bitcoin and Ethereum is so energy intensive as is, will they then lose their practical function and value if other blockchains are coming up? While Ether 2 is being delayed for so long. And I'm not sure if that is Ether 2, I see the person has ETH2.
You had it exactly right. Yeah. ETH2 or Ethereum 2 is this idea of moving from this energy intensive proof of work system to the more carbon neutral proof of stake consensus mechanism. So you could think of it as ETH1 being a gas powered car and ETH2 being an electric powered car. And what Suresh is asking is, does the energy intensity of Bitcoin today, Bitcoin permanently and ETH today, although it's changing, open up the potential for other blockchains to compete? I think the answer to that is absolutely. You know, there are plenty of people who ascribe a high value to ESG, and while they may be attracted to Bitcoin's security and Bitcoin's role as digital gold, they may not be comfortable with those ESG elements, and so they may look elsewhere. It's also the case that new blockchains can be more efficient. My own view, Suresh, is we're going to have a handful, 5, 10, 15 major blockchains that are all optimized in different ways. You can think of Bitcoin being optimized for security, Ethereum being optimized for somewhere between security and functionality. You could imagine a blockchain that's optimized for ESG compliance. You could imagine a blockchain that just tries to be really fast but isn't very secure. I think we're going to see all of it. And I don't really know which will be most valuable. I just think in aggregate, they're likely to be valuable.
Thanks for that response, Matt. And I love the focus that we're giving on ESG in this discussion, because it is very topical now. And as you say, it's something that's passionate for you, and it's something that I am also passionate about. So just FYI for everybody on this call, CFA Institute, they do have a certificate in ESG. And Monique, you can correct me if I'm wrong in how I'm relating this. But yes, feel free to go on the CFA Institute website and find out more about that accreditation. So Matt, we're wrapping up now. So just wanted to thank you again. You came out, you showed us, you shared your knowledge, your thoughts and experience on the topic. And for many, especially in Jamaica and the rest of the Caribbean, we don't usually get this opportunity a lot to engage with someone who has the knowledge and the experience that you do. So I want to say a big thank you for coming out and for giving us this opportunity. We would also like to thank and acknowledge again everybody that we have from across the Caribbean, persons in Barbados, Trinidad, Cayman, and the Bahamas. It was a pleasure connecting with you, and we did see the participation from those persons. So we do appreciate that. We also want to thank the CFA Society Jamaica for putting on and facilitating this event. So thanks again, guys, for joining. But before you drop off, we have one final poll question. So feel free, answer, and then you can enjoy the rest of your evening. Thank you so much again for joining, guys. Take care.
Thanks, everyone.